In this video, I'll be breaking down how much you need to make in order to afford a 2022 Hyundai Ionic 5. You should really consider following one of these rules in order to avoid making a huge mistake that'll end up setting you back for years down the road. I've also included a link to a free auto quote where you could save up to about $600 a year in the description below, but more on that later. There are 4 options I'll be going over today, and you can decide on which one suits you the best depending on how into cars you are personally. Some people just want a reliable form of transportation to take them from A to B, and some are willing to sacrifice quite a little bit more. Stick around to the end of the video to find out which method would be best for your situation. This is 4 Wheel Finance, a channel dedicated to helping you making smart car buying decisions. Before I go into the first rule, these videos take a lot of time and effort to make, so please click the like and subscribe button, comment down what your thoughts are on this or any other vehicles that you would like to see. The first rule is the 24-10 rule, and this states that you must put at least 20% down on the vehicle, you can't finance it for more than 4 years or 48 months, and the payment can't be more than 10% of your monthly gross income. Since the 2022 Hyundai Ionic 5 has an MSRP of $39,950, in this case you'd need to put down about $8,000. And with the average new vehicle interest rate of 3.86% and a 48-month term, this would bring your monthly payment to $719.63. Take note here that you're paying about $2,500 in interest as well. Bankrate states that the average monthly insurance cost is about $148 a month, but this varies a ton from person to person, so use the Smart Financial link in the description below to find out exactly how much it would cost for you. This brings your monthly total to $867.63. Back to that 24-10 rule, given your monthly cost is $867, you would need a monthly gross income of 10 times that, or about $8,676.30, which would come out to about $104,115.60 a year. I really encourage you to take a look at the opportunity cost here. If you were to go buy like a $5,000 or $10,000 cheaper car and put what would be your car payment of $719.63 in the market instead, over the course of 5 years with a very conservative 6% rate of return, this would turn to about $50,247.45, getting over $7,000 in interest here. Take a look at those Acorns and M1 Finance links in the description below. It's super easy to get started investing. You can start with just cents, and I encourage you to get started as early as you can. And this is just for the first 5 years. If you were to continue this on for about 10 years, it would amount to $117,489.88, again, just at that 6% rate of return. And for reference, the stock market typically averages around 10% return per year, so this is relatively conservative. This next rule I've came up with myself. It's for more of a car person or truck person, somebody that's willing to spend a little bit more in order to get the car that they want, but still want to make sure financially they're doing okay. And you need to have at least a 6-month emergency fund, invest 15% of your gross income into your 401k or 403b, and then max out your Roth IRA, and if you really want to be a superstar, your HSA as well. And I know that this does seem like quite a lot of saving, and it is, but there isn't any monthly percent rule that you have to stick to, so it's really up to you to decide if you want to spend more of your free money on car parts, or if you'd rather go on vacations, if you'd rather go out to eat more, or anything like that. And that 6-month emergency fund, obviously it's just there to make sure you're covered in an emergency, because that money definitely adds up quick. And the investment portion gives you a little bit of financial security later in life when you think you'll need it the most. There's a lot of people out there that say nothing's guaranteed, and that's 100% true. Nothing's guaranteed, but it's difficult to put a value on having peace of mind for yourself or your family's future. It's better to have it and not need it than need it and not have it. Next rule is the Dave Ramsey rule, and this states you must have a 3 to 6 month emergency fund built up. It can't be more than 50% of your annual gross income, and you must purchase it in cash. Given the 2022 Hyundai Ionic 5 starts at $39,950, your annual gross income would need to be a minimum of $79,900. And there's a lot of perks to purchasing a vehicle in cash. You'd have to avoid paying that $2,500 in interest, and your insurance would be a little bit lower, but obviously there's not a whole lot of people that have $40,000 in cash that they can put towards a car like this. And the final rule is the 1/10 rule, and that was developed by Financial Samurai, very popular blog that you might have heard of before. Personally, I think the majority of people trying to build their wealth should consider this one. It's pretty aggressive, doesn't allow you to really buy a new vehicle, but it's intended to help you spend responsibly and reducing your car ownership stress financially, which ends up increasing your net worth over time. It's very straightforward. It states that you just can't spend more than 10% of your annual gross income on a car, which means you're buying a bit of a used clunker in this case. And you need to own it for at least 5 years, but ideally more. And the theory is just to minimize your financial stress here. Frees up a little bit of money to make sure that you're investing in assets or opportunities that may come your way. It's a lot more stressful making difficult life decisions when you're worried about payments each and every month. Once again, this is 4 Wheel Finance. If you have any questions regarding car buying or how much of a car you can afford, please leave them in the description down below. And take a look at that Smart Financial link if you want to get a free insurance quote, save a little bit of money there. And M1 Finance, get your 2 free stocks, and Acorns if you want to just start investing. I encourage you to get started as early as you can.